active money managers have just reached a 99% exposure rate to the US stock market. This is a level of exposure that we've only witnessed 4 times before over the course of the last 2 years. And this new data point has just made us shift our portfolio allocation at bravosresearch.com. So this is a short, quick update that we're doing for you guys on YouTube to make sure that you guys are also able to weigh in this risk correctly. This is an index called the NAAIM Exposure Index, and it gives a measure of how exposed active money managers on Wall Street are to the US stock market. Now, most of the time, this is not something that we pay a lot of attention to, but we do pay a lot of attention to it when it starts to get into some extreme zones like it is today. Now, if we add the US stock market, the S&P 500 index on top of this chart, and we zoom out a little bit, we can see that a lot of the similar spikes in this exposure index have coincided with some local peaks in the stock market. Now, all of these readings that you see here are where the index reached 100. Now, a reading of 100 on this exposure index suggests that on average, active money managers, which are institutional investors, are 100% exposed to the stock market. Now, that can be dangerous for short-term market performance, because if some of these active money managers decide to rebalance their portfolios, they'll be selling some of their exposure to the stock market, and that can create some market volatility. It can create a temporary decline in the stock market. And that's what happened in all of these instances. And by the way, the very opposite is true when these active money managers have very little exposure to the stock market. That can often coincide with local bottoms in stocks, because as these money managers buy back into the stock market, it can create an upwards driving force for US stocks in general. So with the recent 99% exposure reading on this index, we've gotten a little bit more defensive on our stock market exposure. And by the way, this is a strategy that we've communicated to our clients a few times over the last couple of years, and that has been very powerful. By the way, we are extending the discount campaign and doing Cyber Monday. So if you missed our Black Friday offer, make sure to take advantage of this one. You'll have access to all of our trades, buy and sell alerts, and our entire portfolio strategy. Now, to be clear, we're not making a high conviction bet on the fact that the market is going to correct right now. As we've mentioned in pretty much all of our recent videos, the price structure of the S&P 500 is undoubtedly bullish today, and the same forces that have been driving the stock market higher since October of 2022 are very much still intact today. One of the major driving factors is this line right here, which is simply long-term US interest rates. Rising interest rates in 2022 were a huge drag for the US stock market. When they began to stabilize in October of 2022, that's when the stock market bull run began. And as you can see recently, we've seen interest rates come back down again, which is quite a good thing for the stock market. You can see all of the times where interest rates have stabilized like they are today, we've seen the stock market make a nice move up. So what we've communicated to our clients is that we're simply rebalancing our portfolio of active trades a little bit, because when other active managers are overexposed to the stock market, it's only a question of time for when they will be rebalancing their portfolios. So it really becomes a game of musical chairs, and you don't want to be the last one standing. You don't want to be the last one rebalancing his portfolio. So we closed a couple of the more risky bets that we had going long on the market and replaced them with other opportunities that we've been waiting to enter. One of them being a long trade on natural gas that seems to be breaking out above a basing pattern right now, and one of them being a short bet, meaning betting against a specific healthcare stock, because we happen to think that the healthcare sector is very vulnerable to declining today. This is what the earnings, so the profits of the healthcare sector, looks like going back to the 1990s. Throughout the last 30 years, we've generally seen their profits go up, right up until the last couple of years, where overall the healthcare sector has seen a decline in its earnings. This is one of the only S&P 500 sectors where that's been the case. And at the same time, when we look at the valuations of the healthcare sector today, it recently reached some of the highest levels since the dot-com bubble. So this is a very weak sector that's not seeing a lot of growth and that is quite expensive. Additionally, we have Robert Kennedy Jr. that's likely going to be making some changes in the healthcare industry, which could further hurt the sector. We think it's entirely possible that the forward PE ratio of the healthcare sector, which is the valuation of the healthcare sector, comes back down to the bottom of the range from 2015 to 2020. That could take the valuation of the healthcare sector down to 14, which would be another 20 to 30% decline from current levels. So this is one of the ways that we're rebalancing our portfolio a little bit, but to be clear, we still very much have a net long exposure to the stock market. We have a bunch of of exposure to different US stocks, and we have long positions on cryptocurrencies that have tons of momentum today. Again, if you want to follow our portfolio and trading strategies step by step, go to our website, take advantage of the discount today. You won't regret it.